Let's continue using T accounts to record our different types of business transactions. For our next transaction, we purchase supplies for cash. Purchase supplies for cash in the amount of $1,500. So once again, you want to identify the accounts involved in this transaction, which are your supplies account and your cash account. Identify the account classification. These are both asset accounts. Ask yourself if the accounts are increasing or decreasing. Our supplies account is going to increase while the cash account is going to decrease. Now apply the rules of debit and credit. These are both asset accounts. Asset accounts increase on the debit side while they decrease on the credit side. Debit our supplies account for $1,500. Credit your cash account for $1,500. Remember, for every business transaction, the total amount debited must equal the total amount recorded on the credit side. Next up, Eli Consulting Services issued a check in the amount of $2,500 to Office Plus. So in this situation, we're saying that we owe someone money, Office Plus. Now we're paying them $2,500. So once again, ask yourself which accounts are involved in this transaction. The accounts involved will be cash and accounts payable. Cash is an asset account that's going to decrease. Accounts payable is a liability account that's also going to decrease. Once again, you're going to apply the rules of debit and credit. Asset accounts increase on the debit side, therefore they decrease on the credit side. Your liability accounts increase on the credit side, therefore they decrease on the debit side. For every business transaction, at least one account has to be debited, at least one account has to be credited, and the amount of the transaction must balance. The total amount debited must always equal the total amount that was credited. We're not done. Next, we issued a check for $8,000 to pay rent for the months of December and January. So we're now paying our rent in advance, which is known as prepaid rent. So the accounts involved are going to be prepaid rent and cash. And again, you ask yourself, what are the accounts classification? Both prepaid rent and cash are both asset accounts. The prepaid rent account is going to increase by $8,000, whereas our cash account is going to decrease by $8,000. We're now going to apply the rules of debits and credits. Assets, prepaid rent, increase on the debit side, while assets, cash, decrease on the credit side. Now, once you have recorded all of your business transactions for that particular accounting period, we now want to determine what is going to be the balance for each of those accounts. Let's look at our cash account. And here we're showing all of the cash transactions that we've just done for chapter 3. Notice that you only have one cash account. So all of our cash transactions go into this one cash T account. To determine the account balance, you're going to add up both sides of the T account, a process known as footing. So on the credit side, the amounts total $17,000. You only have the one amount on the debit side. So right now, our debit balance is $100,000. To determine the account balance, subtract the total on the smaller side from the larger balance and record the difference on the larger side of the account. Say it again. That way. Again, to determine the account balance, you're going to subtract the smaller side from the larger and record the account balance on the larger side of the account. So in this situation, our debit side is larger than our credit side. Therefore, the account balance for cash is going to be $83,000 shown on the debit side of the T account. So you'll do the same process for each of your accounts. Determine what would be the account ending balance by adding out the total of the debit side and the credit side, a process known as footing. Once you have those totals, subtract the smaller side from the larger and record the balance on the larger side of the account. Now, if you only have one amount in the T account, then that represents the account balance for that particular account. Now, although we're using T accounts, the account equation must still be in balance. Your assets must equal the liabilities plus your owner's equity. So once you have the ending balance for each of your account, get a total for all of your assets, a total for your liabilities, and a total for your owner's equity, and the account equation must still balance. Your assets must equal your liabilities plus your owner's equity. We're not done. Let's record some additional transaction. We'll now look at some revenue transaction and some expense transaction. This situation, we sold services of cash in the amount of $36,000. So what you have involved would be the cash account and your revenue account title, which is fees income. Of course, cash is an asset account. Fees income refers to a revenue account. Cash is increasing. Assets increase on the debit side. Fees income is also increasing. Your revenue accounts increase on the credit side. Next, recorded revenue for services sold, this time on credit. So we earned $11,000 from various charge account clients. When it says this means that these clients have not yet paid us, therefore money is owed to the business. Account receivable represents money that's owed to the business organization. So to record this transaction, the account receivable account is going to increase by $11,000. The revenue account will also increase by $11,000. Account receivable is an asset. Asset accounts increase on the debit side. Fees income is a revenue account. Revenue accounts increase on the credit side. Again, every transaction must balance. Your job is to apply the rules of debits and credits. The rules tell us what side of the account will make the account increase. The rules tell us what side of the account will make the account decrease. Next transaction. Charge account clients paid $6,000, reducing the amount owed to Eli's consulting services. So most importantly, you must know how to first analyze these different types of business transactions. Analyze means to identify which accounts are involved in the transaction, determine if the accounts are increasing or decreasing, identify what are the account classification. So we're receiving $6,000 from a credit client. Therefore, the accounts involved would be our cash account and account receivable. Because you're receiving cash, cash is going to increase. Cash being an asset, assets increase on the debit side. The account receivable account is going to decrease. Account receivable is also an asset. Assets decrease on the credit side. And again, every transaction must be in balance. The total amount debited must equal the total amount that was credited. Let's now look at some expense transactions. Next, we paid $8,000 in salaries. So the accounts involved will be cash and salaries expense. Cash account is going to decrease by $8,000, whereas the expense account is going to increase by $8,000. Expense accounts increase on the debit side. Asset accounts decrease on the credit side. Next, we paid our utility bill in the amount of $650, and accounts involved will be utility expense and cash. Once again, applying the rules of debits and credits, your expense accounts increase on the debit side, whereas your cash account is going to decrease on the credit side. Owner's withdrawal. I want you to think about the impact that these accounts have on owner's equity. Remember that revenue will increase equity. Therefore, revenue account will increase on the credit side because an increase in revenue will increase your owner's equity. But expenses and withdrawal, they both decrease owner's equity. So expenses and drawing increase on the debit side because an increase in either of these accounts will decrease your total owner's equity. For example, it said the owner wrote a check for $5,000 for personal use. So if the owner takes money out of the company to use for personal use, that is known as a withdrawal. So the accounts involved will be the owner's drawing account and the cash account. The drawing account, which is increasing, is shown as a debit transaction. Cash, which is decreasing, is shown on the credit side. Once again, every transaction must be in balance. The total amount debited must equal the total amount that was credited. So here is a summary of the rules of debits and credit. Debit means left-hand side of the account. Credit means right-hand side of the account. In a double entry accounting system, the effects of each transaction at debit and credit separate account, meaning that for each transaction, when you debit one account, you're going to credit a separate account. For each transaction, at least one account must be debited and at least one account must be credited. And the last rule, for each transaction, the total amount debited for a transaction must equal the total amount credited for that same transaction. So there you have it, ladies and gentlemen. These are the rules of debits and credits. Now go out there and use T accounts to record your different types of business transactions.